The economy is in real trouble. We have the unfortunate combination of hot inflation and cooling growth. The data is very clear, and you're going to see why this is so important. Inflation is still hot. This week, PPI, Producer Price Index, was announced. On a year over year basis, we're up 2.2%. Now, the headlines allude to the fact that inflation is cooling. At least that's not the case with PPI. We're at levels we haven't seen going back to April of 2023. Now, again, this is a producer price index. It measures the cost of goods at the wholesale level. It's thought that whatever we pay for on the wholesale level, meaning the manufacturers, those costs are passed on to the consumer. We have core PPI that excludes food and energy, the more volatile components of the measure, and that's up 2.4%. That's now touching levels we haven't seen since August of last year. So, at least according to the wholesale prices, we don't see any cooling in inflation. Now, what we're going to show you in just a minute is a combination of growth and inflation. And at the end, we're going to ask you, where do you think we are? A soft landing occurs when we have a good amount of growth and not so much inflation. A hard landing is the opposite, lots of inflation and a cooling economy. Here's a consumer price index released today on a year over year basis, 3.4%. That did not hit the levels of 3.5%, which was a prior month's number. Now, I know we did not hit the analyst expectations. I don't think the analyst expectations are as important as the overall trend. The overall trend tells us this: it's the second highest CPI since September of 23. We also consider the core CPI on a year over year basis that excludes food and energy. That's up 3.6%. And this is probably the bright spot. So if you take out food and energy, inflation at the consumer level is declining. But how important is that? I mean, after all, why are we excluding food and energy? Now, I know the Federal Reserve and the regulatory agencies will tell us that we exclude food and energy because they're more volatile components. But nevertheless, they're still components of our economy. We spend money every day on food and energy. Why is inflation so sticky? Well, we took a look at the different categories within the consumer price index. There are actually many categories. These are the major ones. And in particular, we see two of the strongest categories are CPI housing and rent as a primary residence, both of which are classified as the housing data. And the troubling aspect about this is we know from experience, housing prices don't really come down. It's not like our rent comes down when CPI comes down. You know, there's electricity prices and there's, food at the supermarket. Those prices may decrease over time with buying and selling pressures adjusting, but not so much for housing. And this is really one of the strongest parts of the CPI. So we'd ask you, what do you think? If we're looking for a 2% inflation target, we're going to need the housing and the rent of primary residence to come down. So far, it doesn't look like that's happening. Now, the futures market reacted to all this. And we can see here in blue, that's the probability of a rate cut, and it's broken down by the different meetings, June, July, and so forth. The purple bars show us the probability of no cut. Very interesting. Now, this is today's reaction. And today's reaction, based on the CPI, and yesterday, of course, the PPI, the probability of a rate cut in September and November increased 9% and 8% respectively. The probability of no interest rate cut by that point dropped by the same amount, 9% and 8%. It's very interesting that this seems to be the pivot point. This September and November, specifically September, seems to be the point that the market is now looking to a change. Maybe that's because the market is not anticipating that inflation is going to drop that much in the June and July meetings, or by the June and July meetings. But this is where we stand right now. The red bars show us the probability of a half a point cut, and this is again broken down by meeting. The quarter point cuts are shown in green and no change in blue. Specifically, in September, that's the first month where we have a better chance, according to the Fed funds futures, that the interest rates will be lower than they are now. Not in June, not in July. But September seems to be the pivot point. And again, we point this out because upon the release of any new data, we want to see if this does shift. But so far, we have a 54% chance that we're going to be a quarter point lower. We have a 20% chance that we're going to be half a point lower by September. Now, the other side, we talked about hot inflation, but there's also growth, and it's cooling. Here's the manufacturer's orders. These are the orders placed at the manufacturer level, which eventually will translate into retail sales, which, by the way, we're going to talk about in just a moment. And the news is not so good for retail sales. But first, manufacturer's orders. There's weak spots here. New orders for transportation equipment and durable goods. Again, durable goods are those items meant to last at least 3 years. That could be appliances, aircraft, machinery, computers. Those are the weakest parts of the manufacturer's orders. That's what's being ordered the least. Well, here's durable goods on a year over year basis, up only 0.6%, following last month's report of 2%. So, as bad as last month was, it looks like, it's worse now. We also take a look at new orders in terms of transportation on a year over year basis again, barely in positive territory since this time last year. Not really so good, following last month's 3.7%. So those are the weak spots. But, well, let's be fair. Let's talk about the strong parts of the manufacturer's orders. Well, by far the strongest parts are the consumer goods and the consumer durable goods. Consumer goods are, anything that we buy, t-shirts, etc. Durable goods at the consumer level are those consumer items that are designed to last more than 3 years. Washing machines, appliances, things of that nature. Well, these are the strongest categories, we should say, of the manufacturer's orders. Well, this is what they actually look like. And again, remember, this is the strongest part. Consumer durable goods on a year over year basis, up 2.9%. Yeah, it's better than last month. That was down fractionally. But certainly we can see over time this trend is moving to the downside. It's encouraging, it's in positive territory, but one bar does not make a trend. That was for consumer durable goods. Here are consumer goods that are meant to last less than 3 years, those more disposable items. Again, it's encouraging, it's in positive territory, up 3% since this time last year. But that follows an entire year of negative territory. So certainly, again, one positive bar does not make a trend. Moreover, I think it's important to note the bright spot of manufacturers' orders are hinging on the consumer, not so much aircraft, not so much defense, not so much other categories, but directly connected to the consumer. And the consumer already is not faring very well based on these levels of inflation. Well, we promise also retail sales. Now you have the manufacturer's orders that we first spoke about. Those orders are placed, the goods are produced, they end up on the shelves, and that translates into retail sales. Well, the brightest spot of retail sales is non-store retailers, online shopping. Year over year basis, that's up 7.5%. That's good. Well, retail sales are also cooling. Advanced retail sales. Again, this is non-store retailers. Remember, this is the strongest part of our retail sales, up 7.5%. On the prior chart, it looked good. This is actually the lowest low we've seen going back to, looks like 22. Now, this is from Reuters. U.S. consumer inflation resumes downward trend as domestic demand cools. And in particular, they mentioned U.S. consumer prices increased less than expected in April, suggesting that inflation resumed its downtrend at the start of the second quarter in a boost to financial market expectations for a September interest rate cut. We talked about September. That's the month. But again, it's kind of interesting how there's such a cooling tone on these. And this is not alone, Reuters by far. The vast majority of the articles printed today about the consumer price index said that consumer prices are cooling. Yes, that is true core CPI, but the regular CPI, not so much. Remember, core PPI, year over year basis, that's up 2.2%. That's the highest level since 23. So, we have to read between the lines a little bit. Certainly I think they're kind of cherry picking the numbers. One analyst had mentioned today, well, the prices didn't go up anymore. So that's good news. But we're not in a downtrend, with all due respect to Reuters. Also, they mentioned hopes of the Federal Reserve starting its easing cycle this year were further bolstered by other data on Wednesday. They're talking about retail sales were unexpectedly flat last month. The reports suggested domestic demand was cooling, which will be welcomed by officials at the central bank as they engineer a soft landing for the economy. Now, again, what's a soft landing? Where inflation cools down, but growth is still resilient. Well, I'd ask all of you, let us know in the comments, based on this data and all the other things that we talk about over time, where do you think we are? On the top left, we have the ideal situation. That's with strong growth and weak inflation. We want to see CPI down near the 2% level. I know it's less than last month, but not really close to 2%. Worst case scenario is a hard landing. That's when inflation remains sticky, but growth cools. Kind of sounds a little bit reminiscent of where we are right now. But let us know where you think. Where do you think we land on this chart? Now, of course, the best signal of all is given by the markets. And we spoke about the inverted bond market and an updated look at exactly where we are, specifically the 10-1 spread, the spread between the 10-year U.S. Treasury and the 1-year U.S. Treasury. It's widening. And we spoke about a very specific correlation to stocks. And if you notice what happened today in the stock market and what happened today in the 10-1 spread, well, it's very apropos. So I think you'll really enjoy what we discovered here.